This is not financial advice, educational content only. Every earnings season, the headline is net income. The beat or miss, the cents per share delta from consensus. That number drives the price reaction, leads the press release, and fills the analyst calls. But most publicly traded companies file a second number alongside their income statement, the cash flow from operations. That doesn't care when revenue was recognized. It cares when the cash arrived. Today we're looking at what that statement contains, where the gaps between cash and earnings tend to appear, and how to read those gaps as signal rather than noise. Net income is an accrual accounting construct under US GAAP, the framework most US public companies report under, as governed by the CC's Regulation SX. Revenue is recognized when it's earned, not when the cash arrives. Expenses are matched to the periods they relate to, not when the bills are paid. The logic is coherent. A company that ships product in December but collects payment in January hasn't generated zero revenue in December. Accrual accounting smooths the timing. The problem is that accrual accounting creates room between what happened and what was recognized. Depreciation is a non-cash charge. The factory you bought 3 years ago shows up as an expense every quarter without a corresponding cash outflow. Stock-based compensation is similarly non-cash. Deferred revenue is the reverse. Cash arrives before the company delivers, so it sits on the balance sheet and gets recognized later. All of this is legal, common, and disclosed in the footnotes. But it means net income is a constructed number, and the construction choices are worth examining. That's my read. Every public company filing a 10K or 10Q is required under ASC 230, the FASB accounting standard governing cash flow statements, to include a statement of cash flows. It has 3 sections: operations, investing, and financing. We're focused on operations. The operating section typically starts with net income and then adjusts for everything that caused the accrual number to differ from actual cash. Add back depreciation and amortization, deducted from net income but no cash left the company. Add back stock-based compensation, then adjust for working capital changes, accounts receivable, inventory, accounts payable, accrued liabilities, deferred revenue. That reconciliation is the document. The finished number, operating cash flow, is the cash the business actually generated from running operations during the period. For a healthy, mature business in a stable period, operating cash flow and net income should track reasonably close. When they diverge materially, that divergence is worth examining. The most informative part of the reconciliation isn't the non-cash add-backs. Those tend to be stable and predictable. It's the working capital changes. Accounts receivable going up quarter after quarter means the company is booking revenue but not collecting the cash. That can be normal during rapid growth, new customers on extended payment terms. It can also indicate aggressive revenue recognition or customers who are struggling to pay. The filing doesn't tell you which. The pattern over time, compared to revenue growth, usually does. Inventory building means the company is spending cash on goods it hasn't sold. Net income hasn't been charged yet because the cost hasn't been recognized. Cash is leaving. Sustained inventory build is often a precursor to write-downs, which surface as charges several quarters later. A UCO, grounded in accounting research going back at least to the mid-1990s. The accruals literature in journals like the Accounting Review is operating cash flow divided by net income. A ratio consistently near or above 1.0 suggests the company is converting stated profits into cash. A ratio persistently below roughly 0.7, or one that's declining for 3 or more quarters, is a prompt to dig into the working capital section. This is a screen, not a verdict. That's my read. A few patterns in the reconciliation are worth flagging explicitly. Days Sales Outstanding, DSO, is accounts receivable divided by average daily revenue. Most companies either disclose it directly or provide the components to calculate it. Rising DSO over several quarters means collections are slowing relative to sales. For an asset-light services or software business, DSO rising above roughly 60 to 90 days is unusual and worth noting. For a capital goods company with long contract billing cycles, elevated DSO may be structural. The filing's MD&A section required under Regulation SK often includes management commentary on collections trends. That's where you check. Deferred revenue direction matters too. Deferred revenue increasing means customers are paying in advance of delivery. Cash is arriving ahead of recognized revenue. That's a favorable indicator for cash quality. Deferred revenue shrinking means the company is drawing down a prior liability, recognizing revenue from cash collected in an earlier period. The income statement looks fine, the cash inflow already happened. Finally, capital expenditures appear in the investing section, not operating. Free cash flow, operating cash flow minus capex, is the number most practitioners focus on for capital sustainability. That's not a standardized GAAP line item. Companies calculate it themselves and typically present it as a non-GAAP measure in earnings releases. The components are in the filing either way, and checking the company's arithmetic takes about 30 seconds. This analysis doesn't produce the same signal across every sector, and applying it blindly generates noise. For capital-intensive businesses, utilities, manufacturers, airlines, you should expect operating cash flow to reliably exceed net income because they hold substantial fixed assets and carry correspondingly large depreciation add-backs. The gap is structural. What matters there is whether free cash flow after capex is positive and whether the capex figure reflects maintenance or growth spending. Filings rarely label capex that way. Management commentary in the MD&A sometimes does. For asset-light businesses, professional services, software companies, consumer brands with minimal physical plant, large non-cash add-backs are uncommon. When operating cash flow runs well below net income at an asset-light company, the working capital section is almost always the first place to look. For financial companies, banks, insurers, broker, dealers, the cash flow statement is structured differently. Loan originations and repayments flow through the operating section in ways that have no analog in a manufacturing or services business. Comparing the OCF to net income ratio of a regional bank to a software company produces a meaningless number. Applied within a sector, comparing a company to its own history and to peers with similar business models, the ratio produces something useful. Applied across sectors without adjustment, it doesn't. That's my read. Here's the practical tool. Next time you see an earnings release, before reading the commentary, pull the cash flow from operations and compare it to net income. OCF consistently near or above net income is a quality screen, not a buy signal. Below roughly 70% or declining for 3+ consecutive quarters, go to the working capital reconciliation and look at what's building in accounts receivable and inventory. The MD&A section, required under Regulation SK, usually tells you whether the divergence is timing or something more structural. That's the question worth answering. I'm Diane, back next briefing.